Hey everybody, and welcome to Financial Ninja Training Course. I am Brandon Vaughn, and today I'm going to be walking you through hopefully everything that you feel like you need to know as a business owner to be able to make sound decisions, how to read a profit and loss sheet, a balance sheet, a statement of cash flows, how to be able to put together a solid budget and hold yourself accountable throughout the year so that you hit your goals. I mean, at the end of the day, that's what it's all about. Hitting your goals, hitting your targets, maybe destroying them and smashing them to pieces. But my job right now is to help you guys have a really good, solid understanding on some of these very important documents that will help guide you as a business owner. So with that being said, welcome to Financial Ninja Training. So we're going to go ahead and walk through this. But first, what I'd like to do is I'd like to talk about why this stuff is so important. Now, first, as a disclaimer, I just want to let you know that my goal is not to turn you into a CPA, okay? I'm not going to try to turn you into an accountant. I don't want you to be an accountant. I want you to have just enough information so that you feel confident in taking a look at some of these things. You feel confident having conversations with your CPA. How awesome would it be if when they start throwing around things like, or do you run yourself as cash basis or accrual basis? You'll be able to say accrual basis. Absolutely, of course. Or when they say, how should we measure this depreciation of this piece of equipment for the next 5 years? You'll be able to blast that out without feeling stupid or weird or silly. And you'll have a good understanding on this. And this stuff is really, really important. So let's talk about a little bit more why this is important, why it's important to be able to have a good solid grasp on this kind of stuff. Now, first off, I am not going to be replacing your CPA. So you want to check in with your CPA after we go through this course and make sure that your local tax regulations in your area still apply. But this is really giving you a nice foundation, a lot of principles that will help guide you through this. So why is it so important that we find out how to read a profit and loss sheet, a balance sheet, a statement of cash flows? Well, the amazing thing about these documents is they are the universal language in business. You could take a company in Thailand and you could take a look at their profit and loss, their balance sheet, and their statement of cash flows, and you could accurately, as long as they're putting the data in accurately, you could accurately be able to tell how healthy their business is. You can actually compare it to other businesses inside of the same industry. This is a universal language, and honestly, it's one of those things that I wish every single school taught our kids how to be able to read these types of documents, because they're so universal and so elementary in business. Everybody needs to understand how this is ran, especially since the world's economy is ran on the shoulders of businesses. In the US, the majority of businesses are small businesses. So small business owners like yourself and myself need to be well versed in these types of things. The important thing is too to remember, over 85% of businesses fail. And oftentimes it's because they lack a basic understanding of finances. How to be able to look at these things and identify problems long before they come and cause their businesses to crash. Cash is the lifeblood of your company. And if you run out of it, you die, just like blood. If you run out of blood in your body, you're dead. So being able to understand how cash is coming into your business, how it's exiting your business, and to be able to compare yourself to other businesses inside of your own industry is a really, really important skill set to possess. The other reason why this is important is that you need to understand your finances if you're going to plan for growth, and if you're going to make important decisions. You need to have this key data. For instance, can I afford to hire this office manager right now? I'm really, really stressed out in the office, but I don't know if I can afford to hire an office manager. I don't know if I can afford to buy that piece of equipment that I really, really want. I think I can. I need it. And of course, there's lots of different facets that kind of come into this, how your sales pipeline is, etc. But at the core of it, can your cash flow support it? Now, banks know all of these formulas, and they know whether or not your debt to income ratios, your asset to liability ratios, they know exactly what these are when they do a data request for these documents. But do you know what those are? Do you know what banks are looking for? Are you bankable? That's why this stuff is important, is that it impacts every decision that you make inside of your business. At least it should. And finally, being a financial nerd can make you a lot of money. Being able to understand these concepts that are universal in business, they can make you a lot of money and make you maybe want to dab like Bill Gates right up here, right? So being a financial nerd can make you a lot of money. It can help you plan for growth, and it can make you feel really, really confident to be able to make sound business decisions. All right. Now we're going to go ahead and move into the first part of this course, which is understanding your profit and loss. Okay, so here's an example profit and loss. Now, the amazing thing about service-based businesses is that a lot of these percentages are really going to be pretty close to the same. Whether you are in the plumbing industry, the electrical, the HVAC, the home services industry, landscaping, cleaning, for the most part, these percentages are actually going to be pretty close. But for our purposes, what I decided to do was take and create a fictional cleaning company called Merica Cleaning Company. So this is what a profit and loss looks like. And what I'm going to do is I'm going to go through and I'm going to break down every single one of these components and show you that this form, with all of the numbers and percentages and everything that it looks like, at the end of the day, it's just a math equation. And it's actually a really, really simple math equation. So let's go ahead and go through this math equation. So I'm going to break down every single individual component here on a profit and loss sheet. We're starting off with the very, very first chunk, which is income. Next, you have COGS, or cost of goods sold. Now, in service-based businesses, it can also be called cost of services, since we don't actually sell goods. And sometimes this is one of those areas that kind of confuse business owners. They hear cost of goods sold, but they're in a service-based business like my own, it's a cleaning company, and they say to themselves, well, I don't really sell goods, I sell services. So it can also be known as COS, cost of services. But for this part, since QuickBooks automatically spits out cost of goods sold, we're going to go ahead and refer to it as cost of goods sold. And then if you notice this formula at this very, very first part, this is the profit and loss sheet. Income minus cost of goods sold equals gross profit. So gross profit is different than net profit, and I want to go into a deep dive of each one of these sections. But the very, very first formula that we have in a profit and loss sheet is income minus COGS equals gross profit. The next part of the formula is gross profit minus expenses equals net profit. And net profit, also known as the bottom line. This is when you take $100 and put it into your business and pay everything down. How much does the owner actually able to draw from? How profitable is the business? And this is a very, very important number. It's important to track, and we're going to do a deep dive in each one of these sections so that you feel like a profit and loss ninja master, or at least enough to be able to make good decisions. And that's really what we're going for. So we're going to go ahead and take this first chunk here, income. So important thing with regards to income is that it's also known as gross sales. When you go out and you sell, like this company right here, Merica Cleaning Company, $500,000 worth of soft washing, that's going to all be categorized as gross income or gross sales. It's also referred to as top line revenue. Perhaps you've heard of that before, top line revenue. If you notice, it's the very, very top line on the profit and loss sheet. Income is always the very, very first thing on a profit and loss sheet. Now, one of the things that I'd recommend for you to do is to keep the number of income accounts that you have kind of limited. I've seen a lot of different books from a lot of different companies, and some of them have a tendency to say soft washing sales, gutter cleaning sales, window cleaning sales, dryer vent sales, pressure washing sales, all these different types of sales. And while some of that can be kind of good to track inside of QuickBooks, It's really best suited for like a CRM system, like Service Titan or Service Monster or the Customer Factor or Jobber or Service Autopilot or one of those CRM systems. It's almost best to run those types of reports inside of something like that as opposed to your actual financials reports inside of QuickBooks. So my recommendation is to try to keep those number of income accounts kind of limited. Now let's talk about cash basis versus accrual basis. So if you notice all the way down on the very, very bottom, this report is ran as accrual basis. Now I want to kind of slow down and talk about this because this is something that was confusing for me for quite some time as a business owner, and it's an important thing to understand how this works. Now I would have my CPA, he would say, I want you to run these reports as accrual basis, or run these reports as cash basis, because it kind of depends on how taxes are being prepared as to which two that you're running them as. When it comes to income, I'll tell you the difference between cash basis and accrual basis. So we're going to go ahead and come over here to this whiteboard, and I'm going to just go ahead and write in cash, and then I'll write in versus accrual. Cash versus accrual. Okay, so now cash basis has to do with jobs that we have actually received the cash for the job. Accrual basis has to do with jobs that we have invoiced. We've completed them, we've sent the invoice off, but we haven't actually received the money for that yet. So let's take accrual basis. Let's say we finish cleaning an apartment community and they have like a net 30 account. So if it is March 30th and we complete the job on March 30th and we send an invoice off for $10,000, right? So we're going to go ahead and we'll send off $10,000, 10K sent off on March 30th. The accrual basis, when I generate an accrual report, this $10,000 is going to show up inside of March. If I was to generate the report on a cash basis, that $10,000 would show up when I actually receive the check in the mail and then enter it in as a deposit. Okay, so if that is 30 days from then, let's say they pay me, about 28 days later or 30 days later, and I get paid inside of April, then this revenue is going to show up inside of April, because that's when I actually receive the invoice. So that's the difference between cash basis and accrual basis when it comes to receiving income. Now, for my purposes, since we have several accounts that we use where we have net 30, it really doesn't matter necessarily which one you use, just as long as you understand how they are being presented to you when you're generating a report. Me personally, I run everything on an accrual basis because I have a budget sheet that I use in Excel that keeps track of my cash flow and some of the other things that I run later on. But just so you understand the difference between cash basis and accrual basis, accrual is when you generate the invoice, that income is recognized. Cash basis is when you actually receive the check in the mail from that job. Okay, next we are going to move on to our cost of goods sold. So what are cost of goods sold? What are these COGS that everyone's always talking about? Well, I like you to think about what are the cost of goods sold. Let's take a baker, for instance. So let's say I own a bakery and I create these delicious, delicious cupcakes. So I sell my cupcakes for $5 a piece, right? That's going to be my total income is $5. So $5, I sell a cupcake. That's how much income I receive off of those cupcakes. My cost of goods sold would be all the ingredients that it takes to create that cupcake. It would be the flour and the eggs and it would be the sugar, and it'd be the icing, and it'd be all the other little decorations. It'd be the little paper sleeves that those things would go into, right? Whatever it costs me to create that good that I sell, that is what would be my COGS. I'd also have to factor in how much I'm paying my baker to actually create those delicious cupcakes. So if it takes him, let's say an average of, I'm just going to make up a number here, 5 minutes to create that, then that labor that I pay the baker to make those goods would also be included in my COGS. Now, we do not sell goods. We sell services. So we're going to go ahead and walk through what are the cost of goods sold or the cost of services in a service-based business. Well, they're expenses that are created only when the actual services occur. So for instance, in an example of this cleaning company, you're going to have automobile gasoline. If you have a truck that has to drive out to a customer's house, it incurs gas whenever it delivers the service. If we have to have the brake pads fixed, or what I like to include in my COGS are all the maintenance things like brake pads and oil changes, because every 3,000 miles you got to get this stuff done. So it's a variable expense based upon your services that you're delivering. Another thing would be chemicals. If, for instance, I'm soft washing and I use sodium hypochlorite and some kind of surfactant and maybe rust removal chemicals or those types of things, in order for me to deliver those services, when I deliver those services, I will consume chemicals. If I have a sales guy that goes out and sells jobs and I pay him a commission, that's also going to be directly tied to those services. When he goes out and delivers those services, the sales guy gets paid commission when the job is completed. So that's also a cost of goods sold. We also have equipment rentals, small tools and supplies. Now I want to talk to you really briefly about the difference between small tools and supplies. Actually, let me get to that in just a sec. I want to put a quick pin in that. I changed my mind. Small tools and supplies is going to be one. Subcontractor expense. If you go out and you hire a subcontractor to do $10,000 worth of work, but you have to pay him $5,000 in order to complete that job, that's a direct expense for when you deliver the service. And your biggest expense that you have in your company as a service-based business is the payroll that you pay your technicians. How much you pay them to go out and actually deliver those services. So cost of goods sold are expenses that are created only when the services occur. And we'll talk a little bit more later on why and how COGS are different than expenses here, regular expenses, in just a minute. So these are variable expenses. So if I sell $10,000 worth of services, it's going to pretty much be the exact same percentage as if I sell $100,000 worth of services or $1 million worth of services. The percentages are pretty much going to be nearly identical to how much revenue that we're bringing in. So let's say the percentage that in the instance of this company is about 45%. So if I have $10,000 worth of revenue, my cost of goods sold will be somewhere around $4,500. If I have $1 million worth of revenue, my cost of goods sold will be somewhere around $450,000. So it's this variable expense that is directly linked to your top line revenue. And again, it's also called cost of services in our business, in a service-based business, or cost of revenue. All three of these acronyms are kind of interchangeable a little bit, and in all reality, cost of services or cost of revenue, it's a little bit more accurate than saying cost of goods sold, because you're actually selling services as opposed to actual goods. So now I said we were going to go ahead and go briefly over small tools and supplies. A lot of people, when they're entering in their data, they really don't know what belongs in small tools and supplies and what belongs as, let's say, an asset, or what belongs as a shop supply and tool. So when you're buying these different kinds of supplies, little small tools and supplies. The rule that I kind of have as to whether or not it's going to be categorized as a small tool or supply is if it's disposable. If you're not planning on keeping it for longer than, let's say, a year, or if it's under $300. So let's say, for instance, extension poles. Now, we all hope that we keep extension poles for longer than a year, but sometimes employees, they lose stuff, they break them, they drop them off of a ladder, they drop them off of a roof, and they end up breaking them. So they're kind of more disposable. Brush heads, screwdrivers, squeegee rubbers, any kind of disposable items that would be there would be something that would be included under small tools and supplies. Now, if it's over $300 and you expect it to last for more than a year, it actually won't appear anywhere on the profit and loss sheet at all. It's actually going to be categorized as an asset of your business. It increases the value of your business. So let's say a water-fed pole or a pressure washer or a tree trimmer or a weed whacker or a riding lawnmower. Those types of things won't actually appear anywhere on the profit and loss sheet. They're going to be categorized as an asset of the business. So it's important to understand that small tools and supplies are basically the little everyday tools and supplies that you have to buy for your business that are consumables of your actual company when you create those services and you deliver those services to the customer. And the biggest part with regards to payroll with your technicians, it's really kind of a fully loaded cost. Your workers' compensation insurance, the taxes that you have to contribute for your employees, as well as any kind of benefits, all of these are directly tied to your cost of goods sold. It's kind of an all-encompassing number for your payroll for your technicians. And kind of a good target for a service-based business is somewhere in the neighborhood of 40% to 50%. That's kind of a good target. So in the case of this company, we have their total income is $500,000 and their total cost of goods sold is about 45%. So, it's right about there in the sweet spot. Some of the things may be a little bit high, like commissions, or maybe they're a little bit low. Maybe you don't have any subcontractors expense. But really, if you're over 50% for your cost of goods sold in a service-based business, it might be a good opportunity to kind of take a look at them and find out why they are so high. And I'll go into that in just in a moment when we start going after our gross margins. So the next section that we're going to talk about is gross profit. So going back to that formula, we have income minus cost of goods sold equals gross profit, or it's also known as a gross margin. Now, for service-based companies, the gross margin or the gross profit should really try to be over 50%. So, as far as this formula here, if you have your income and you're minusing off your cost of goods sold, the gross profit is pretty much just what's left over. So if you, as you can see here, 100% is our income, you're minusing 45%, and that equals 55% as far as what's left over. So it should be, opposite of whatever your cost of goods sold are. Now, what happens if you're taking a look at your gross profit and you're recognizing that it seems like it's a little bit on the low side? What could be impacting this? Well, it could be several different factors. You could just simply be paying your technicians too much. Maybe you're paying a little bit higher than industry average and you're attracting some really, really good talent. Perhaps though your prices are too low. And if you are getting really talented technicians, maybe you're not charging enough for your jobs. That can also impact your gross margin or your gross profit, to be able to realize that you have to go in and maybe balance some of that out a little bit. And one of the things that I look for as far as a payroll for technicians, typically I like to see those anywhere from about 25% to about 35% is really a good percentage as far as just payroll technician alone. And we can go into that a little bit more later on. But another thing that can impact your gross margin is if your scheduling is just really inefficient. So if you're routing your jobs and you're sending them from one side of town all the way over to the other side of town, then all the way up north to another side of town, then all the way south to another side of town throughout the day, this can impact your gross profit. This can impact your margins, and it can start skewing off your percentages a little bit. You also just may have too many callbacks. If you send a technician back out to go fix something that they, didn't clean all the way, or they forgot to edge the lawns, or they accidentally burned some landscaping, or they left some tools and supplies back on the job site, and you have to pay them to go back out and do that, that can really swing your gross margins, percentages off a little bit. So this gives you kind of a narrative for you to be able to figure out, why are my margins not really where they should be? Another thing is maybe you're not maintaining your equipment very well. If you have a lot of pumps breaking, or small engines breaking, or your van's breaking down, or your truck's breaking down, perhaps they're not getting maintained well enough, and you're losing a lot of production capacity because you're not maintaining these on a regular enough basis. So this can also really have a big impact on your gross margins as well. And the other thing too that's a real possibility is if your gross margins or your gross profit is looking really low, if it's lower than 50%, it could be that maybe your data isn't really clean inside of QuickBooks. Maybe you're not actually going in and separating out your technician payroll correctly. Maybe you have your own payroll in there, or you have an office manager's payroll or something. You have to make sure that you're splitting out your payroll technicians from your actual administrative payroll, or even your owner's salary down below in your general sales and administrative expenses. So making sure that you have really clean data in your QuickBooks or your accounting software is also really, really important as well. Okay, the next thing we're going to talk about, the next section, is going to be expenses. So now we have gross profit minus expenses equals your net income. So this is the last chunk of data that you'll find on a profit and loss sheet excuse me, that identifies all the other expenses that it takes to operate and run your business. So these expenses that are in here are different from cost of goods sold. So your COGS are expenses that are created when your services actually occur. These type of expenses down here are ones that are created whether or not these services occur. For instance, your rent. You still got to pay rent. You have to pay your utilities. You got to pay your insurance, your dues and your subscriptions, your internet expenses, your business licenses. You still have to repair, large automobile repairs. It's one thing that I typically break down as expenses are, large repairs like your engine blows up on one of your trucks. That's not really directly tied to your services. That's kind of one of those one-off things that just kind of happen. Your advertising and promotion. Now, you may kind of look at this as an actual variable expense based upon your total revenue, but you can advertise and not create any services. You could be really upside down in your advertising and your promotion, and it has no bearing on whether or not you're actually going out and doing your services. So as far as all these expenses, most of them are going to be fixed expenses, which meaning they're just kind of a set price. And then some can be slightly variable, which means that they're kind of linked to your overall revenue and could be like a percentage, but some of them will kind of stay flat. So going through here, we have office expenses, an owner's salary. Owner's salary is something that's actually really, really important to consider when you're running your service-based business. I've seen a lot of people comment that they have these really, really high profit margins on their company. They'll say, man, you're saying that 20% is a good target. I run at 60%, profit margins, or 80% profit margins. These crazy, crazy, crazy high numbers. Well, the problem with that is that they typically, in fact, I can just about guarantee it, they're not paying themselves and expensing out their own salary as an owner. Now, I don't care if you're an owner-operator or if you have an LLC or an S-Corp or whatever your business structure is. It's always a good habit to get into paying yourself a reasonable salary. Now, a reasonable salary, and again, I'm not giving tax advice here. You want to consult with your own CPA about this. But is my opinion with regards to a reasonable salary is, what would you pay someone else to come in and replace you? How much would you have to pay them to come in and replace you as an owner and have your business still operate smoothly and successfully? That could be 50K a month or 50K a year. It could be 80K a year. It just kind of depends on what you feel is reasonable for your service-based business. But you don't want it to be too low, and you definitely don't want it to be too high as well, because you can actually get some tax breaks by paying yourselves through distributions of profit rather than simply just through one big, huge, fat salary. But again, this is something you want to talk to your CPA about. But whatever number you choose, make sure that you're putting it as an expense of your company, because it does impact what your net income is going to look like at the end of the year. And especially if you're going to be comparing these to other businesses in your industry, you're going to want to make sure that you have clean data that you're inputting, so that you're getting good results coming out of it. Now again, I'm going to talk about what types of tools and supplies should be categorized as a cost of goods sold, and what kind of tools and supplies should be categorized as an expense. So one of the things that I like to call these is, I like to call them shop supplies and tools, to kind of differentiate these. So let's say you buy an air compressor and a socket tool set for repairing broken down equipment inside of your shop. So your field equipment, you want to repair it, and inside your shop you buy these shop tools and shop supplies like rags and things to take care of stuff. It doesn't generate revenue, but it does help out your business. It's an expense that helps your business run. But these types of shop supplies and tools, they are not an expense that occur when you go out and generate revenue. They're something that is kind of more of a fixed expense, and they're created whether or not your services occur. So make sure that if you're buying tools and supplies, you look at 3 locations, whether they go up in your cost of goods sold as small tools and supplies. Remember, under $300 and will last roughly less than a year typically, or if they're being used inside of your shop as a supply or tool, or if they're really an asset, which is over $300 and will last typically longer than a year. You're going to be coding those and categorizing those as more assets of your company rather than either one of these 2 locations here. Hopefully that makes sense. And with regards to your expenses, typically 25 to 35% is a good target. Now, if you are an owner-operator business model, let's say you have a home-based business, typically your expenses are going to be a lot less. They could be pretty lean when you're running it that way. It kind of depends on what your business model is. If you have a fixed shop, you have a commercial location, these can be higher or they can be lower depending on what kind of business model and what size company you are right now. But typically 25 to 35% is typically a good target when you're operating at about a $500,000 company size. All right, now let's get to my favorite part of the profit and loss, the net profit. This is referred to as the bottom line. Have you ever heard people say that? What's the bottom line? What's your bottom line? Well, it just so happens to be at the bottom, the very, very bottom line of your profit and loss sheet. That's where that comes from. So your bottom line refers to, the net profit in your company. And for a service-based business, you really should be targeting around 15 to 25%. Now, there are businesses out there that can be much higher than this, and they can also be lower than this. Some things that may impact, kind of what your final percentages are. And let's say you're scaling and growing really, really quickly. Like for us, we went from $100,000 to over $4 million this year, and every single year was a lot thinner margins. And the margins that we took, we actually reinvested them all back into the business. There was one year where I only operated at a 10% profit margin. I was learning, I was making a lot of mistakes, I didn't really quite know how to manage some things. And so that cost me some net profit in my company as I was scaling. But it can also be high when running as an owner-operator. If you have, you don't have, let's say, administrative payroll, you don't have an office manager yet, so you're kind of doubling as the office manager. You can run really, really high owner-operator numbers, as high as 30-40% oftentimes as an owner-operator. But it just depends. As you start scaling and kind of growing your business, it could drop down a little bit, and then as you get bigger, it can increase back up again. But typically what we want to target for is about 15 to 25%. And the final caveat I'll throw in here is that your net profit percentage can be all over the place when your data is not clean. And I mean all over the place. I've seen comments on forums and Facebook groups where people just throw out these numbers where it's like, oh man, I just know that your data is not clean. I just know that you're not paying yourself an owner's salary. You're not categorizing certain things correctly, or you're buying a pressure washer and you're throwing a $2,000 pressure washer up under your cogs or your shop supplies or tools. Rather than putting it on the assets side on your balance sheet. So there's lots of things that can impact that. So that's why it's so important to make sure that you kind of have a good standard in doing this, and why I think that every single person should have a good understanding on how to categorize these things, because sometimes your CPA doesn't even know. You gotta love CPAs and accountants, but they manage a lot of different industries and a lot of different businesses, and sometimes they just may not have a real clear understanding of your specific business and how things are supposed to be coded. And there's also bad CPAs out there, just like there's lots of different companies out there. So you want to make sure that your data is going in clean into it. So let's talk about what's missing. So we saw all of these different components on here. We saw all these expenses, the cost of goods sold, but what things will you not find on a profit and loss sheet? Yes, you will not find all the data that you need to know on just your profit and loss sheet alone. You'll find these on your balance sheet or perhaps a statement of cash flows. And the things that I want to talk about here are things that you'll find in a completely different document than your profit and loss. The things that you will not find on your profit and loss sheet, if you're coding your data correctly, you won't find large equipment and assets. So for our business, we actually take ladders. Ladders are considered assets because they're over $300 and they last longer than a year. And it's kind of, right at that time, right at that, kind of gray area where should they be coded as an asset or a cost of goods sold. But for us, we even take ladders and we put them aside as assets because we'll have ladders that'll last us 3 years, plus. And some of the ladders we buy, they're really, really nice ladders and they cost $400 or $500 plus. Pressure washers, water-fed poles, any large pieces of equipment that you buy for your business, you won't find those anywhere on the profit and loss sheet if you're putting your data incorrectly. They'll appear somewhere else. Same thing with all of your bank loans and your payments that you make. So let's say you buy this really, really nice brand new Ford F-250 truck, Ford F-350, or if you're a Chevy guy, a Chevy 3500 Super Duty. And you go out and you buy these vehicles. Sorry, I said Chevy Super Duty. That's a mistake. Anyways, you buy these vehicles and you have a $350 a month payment that you have to put on there. These will not be coded anywhere as an expense or a cost of goods sold. Those payments are actually considered liabilities, and you're paying down your liabilities, and that actually appears on a different document as well. Your credit card balance payments. Let's say you have a credit card that has a balance of about $10,000 on it and you pay $1,000 on it. That's not going to appear on your profit and loss sheet. Your sales tax. If you're in a state that has sales tax, we're actually in a couple different states. In Oregon, we don't have any sales tax, but in Washington, we do have sales tax. And you kind of act as the tax collector. Right? You're taking the tax, your percentage, you're putting it in your bank account, and then you're paying it just straight away to the government. This is not an expense. This is a liability that you incur when you actually decide to take that as that tax and be a tax collector and send it to the government, which unfortunately they require you to do. But that is also not on the profit and loss sheet. Employee contributed taxes. So when you do withholdings of your employees' taxes for federal and potentially state taxes, that does not appear on your profit and loss sheet. Your bank account balances, your accounts payables, your accounts receivables, all of these things appear on your balance sheet. And we're going to go into a deep dive on the balance sheet and how that too is also just a math formula. And it's really, really simple to look at once you understand the concept of it. But that's where you'll find all this information is actually on your balance sheet itself. So now you can see why it's so important to make sure that you're putting clean data into your QuickBooks and you're putting these into all the correct accounts. I'd like to talk for a real quick second about the importance of having clean data inside of your accounting software. So first off, with regards to capital expenditures versus small tools, this is something that we've talked about already, and so I'm only briefly going to touch upon this. But it's really, really important that anything that is an asset of your company, vehicles, small equipment, large equipment, things that'll last you for several years, those types of things, shop improvements, anything along those lines, they have to be categorized as a capital expense and not as a small tool and supply. It's also really, really critical to separate out your cost of goods sold, especially when it comes to your technician labor. In QuickBooks, there's a feature that you can go in there and you can pick which employees of yours are actual field technicians, and you'll put them all inside of one account for all of your payroll for your technicians. And then all your office people, you can go ahead and code that all into your office administrative payroll. And you can separate that out really nice and cleanly so that all of your numbers are, populated in the correct places on these reports. Owner's salary. It's very, very important to make sure that you are paying yourself an owner's salary, and that's reflected in your profit and loss sheet. Another thing too that you notice if on all of those profit and loss sheets that we had was that I had these little 4-digit codes at the beginning. These are called GL codes, or general ledger codes, and these are just a way of kind of organizing some of your accounts so that you can at a quick glance take a look at them and to be able to identify if they're an income account, if they're a cost of goods sold, if they're an expense account, if they're a liability, or they're an asset, or they're an equity account, etc. So I'm just going to go ahead and zip back here really quickly so you can just kind of see. So income accounts start with a number 4, and you can number these however you want to number them. But anything that's an income account typically starts with a number 4. Anything that's a cost of goods sold typically starts with a number 5. And anything that is an expense starts with a number 6. And that's all I'm going to touch on, since these are here on our profit and loss sheet. But those are general ledger codes that you can use to kind of help quickly at a glance take a look at some of your accounts and understand what kind of an account it is. If you look at small tools and supplies and you see it start with a 5, you know that it's going to be a cost of goods sold. If you see something that is a shop supply and tool that has a 6 in front of it, you know that it's going to be categorized as an expense. Getting back to this, depreciation. Depreciation is also a very important concept to understand when it comes to accounting. And I'm just going to take a quick minute to just kind of expound upon depreciation a little bit more. Depreciation is how quickly an asset loses its value or expenses out its value over a period of time. So for instance, let's say it's January 1st and you buy $20,000 worth of chemicals because you're getting this fantastic, incredible price to buy all of these chemicals all in one batch. Well, depreciation schedule would be something where you would take those and you would expense them out over multiple months. So rather than just having, boom, a $10,000 expense just hit in January, if you're running the accrual method, you could say, all right, we want to go ahead and just put, let's say $2,000 in January, $2,000 in February, $2,000 in March, $2,000 in April, and it kind of has a schedule of how quickly you'll be able to kind of use up those chemicals. Depreciation also comes into play when you buy, let's say, a vehicle. Your accountant will say, what's the useful lifespan on this vehicle? And you'll have to say, well, I think this vehicle will last me, about 5 years. And let's say you bought it for $10,000. They'll put together a depreciation schedule where they'll depreciate, $2,000 of an expense for each one of those years rather than all $10,000 of that all being depreciated all at once. And again, I don't want to go too deep of a dive into some of the schedules and things that you can take advantage of when it comes to tax breaks and depreciating things all at once as opposed to splitting them out over years. But it's important to understand how depreciation works and why your accountant will ask for information like that, especially when you're running on an accrual basis as well for your expenses. The next thing I want to talk about is expenses, business expenses versus personal expenses. This is something that is so critical, and I don't have to talk very long about it because I'm sure you guys will totally agree with me that business expenses and personal expenses have to be separated out. If you're going to go on a vacation or you're going to go on something, or you're paying some of your bills out of your business account that are really your personal expenses, you need to have clean data. And if you start muddying this stuff up, it's going to be very, very difficult if you ever get to a point to where you go to a bank and they get this information and then they're very, very confused, let alone the tax implications and the liability you can be opening yourself up with, the IRS, for instance. And the other thing is to remember that clean data is really, really important for selling your company. If you're going to be selling your company at some point down the road, the potential buyer is going to want to make sure that you're paying yourself an owner's salary, because when they buy your company, they need to know how much they're going to have to pay someone to replace you. Because when you exit, your business hopefully is still running without you. And if they see that you're still profitable, even though you're paying yourself an owner's salary, they're going to understand that that business will be profitable if they have to replace you and you exit out of the business. So that's also why it's very, very important to have make sure that you have clean data. And let me tell you, if this is not your strong suit, entering in all of this information and it makes you frustrated and crazy and you are not very OCD when it comes to your accounts, you have to hire somebody to do this. Don't try to do it your own. Perhaps maybe your spouse is not the best person to be your accountant or your bookkeeper, or a family member or a friend. Perhaps you need to really get someone who's an expert at these types of things, who understands the importance of clean data, so that when you get your reports, you know that they're accurate. You know that you can make good, solid business decisions in moving forward. So hopefully that gives you guys a good overview of what to look at, or of understanding when you're taking a look at a profit and loss sheet. Coming up next, we're going to take a look at the balance sheet as well as the statement of cash flows. And then after that, I want to take you into a super, super deep dive of how you can create your entire yearly budget and project for growth, and to be able to hold yourself accountable throughout the year and always have a pulse on how your business is health-wise from month to month. We'll see you in a bit.